think that we're in very much a situation that is akin to the 60s. And I'll share another screen with you. So you've got CPI at the top and you've got government spending, right? So this was late 50s into the mid 60s, halcyon period of post-war economics in the US. Inflation's averaging, I mean, not even 2%, 1.5%. And you can see it's an incredibly tight range, right? Kennedy gets assassinated. Johnson wins both houses on a sympathy vote, and he pushes through what Kennedy wanted to introduce. It's called Johnson's Great Society, but it really was Kennedy's Great Society. And you hit an economy which was running pretty much firing on all cylinders, was doing incredibly well, and it was really unnecessary to do this big bump in expenditure. And what do? Is you knock inflation out of the range. Now, back then you had a Fed that thought they could run it a little hot in exactly the same way that you did now. And what you started to do is you push inflation from 1.5 really here where they start the program up to just shy of 4. Okay. And then the Fed comes in and they hit it, and they hit it quite hard. And this, to me, this is the comparison here is what Trump did, utterly unnecessary pro-cyclical stimulus in an economy that didn't need it, right? And you do that initial kicker to inflation. Then this is 2018, the Fed comes and hits it. Same thing happened back then. The equity market dropped 20% here. Actually, housing stumbled. There were some idiosyncratic things around S&Ls at the time, but the Fed backs off. Okay. Now, so
just to recap, you mean 2018 when Powell started tightening?
Correct. It's akin to sort of 1966 here. Yeah. So inflation drops. Obviously, COVID has complicated it yet again. But what are we doing? We're basically going into ongoing spending, easing into ongoing fiscal spending, and we're easing with inflation structurally higher than when it was, say, in the GFC, right? I mean, I'm looking at wage models. I'm just looking at them today. Average hourly earnings dropped to 1.5%. Now, average hourly earnings are screwed up because you've lost a lot of people out of the workforce with low wages. But when I look at my models, I don't see any of the wage models dropping back to 1.5%. They're all beginning to base. They've come off the highs around 3.5 to sort of 3.8 for average hourly earnings, but they're basing around 3. And some of them are showing signs of picking up again. So we're easing into these cyclically higher rates. And this is what we are. Now, you don't have to go here. This is the 70s, right? Mm-hmm. I know people will go, oh, yeah, but the point is we could just be in the late 60s where we go from 1.5 to 4 to 6. Now, for a treasury investor in this period here, guys, you lost 1/3 of your money in real terms in 5 bloody years. This is financial repression. We haven't even got to the 70s, right? We still have a pegged currency. We still have pegged oil prices. We still have pegged shipping prices. So this is, you could do it.
In 6 years, you have the purchasing power.
Yeah, your purchasing
power. The average American,
Yeah, just gets, it's certainly in fixed income terms, gets eviscerated.